And it's this clustering effect that makes playing the game so difficult, because you get long runs of good trades where you think you're God, and wrong runs, unfortunately, of bad ones where you feel like something that's under your shoe. Now, the first objective is to live through the clusters arithmetically, that you don't go broke in them, because you can quite easily have a cluster of 5 bad trades. 5 bad trades happen on a 50% system every 32. So if you were to bet 20% of your loot on any one particular trade, you go bankrupt every 5. The gist of all of this is that you should not risk any more than 1 to 2% of your kitty on any one trade. So if you've got 100,000 rand in your account and you're new to this, you should not risk any more than 1 to 2% of that in any one trade.
What David Paul explains here is one of the most uncomfortable truths in trading. Losses do not arrive one at a time. They arrive in clusters, often when you least expect them. If your position size is too large, even a normal sequence of losing trades becomes enough to wipe out your account. The lesson is clear. Risk management is not about limiting damage. It is about ensuring survival. Welcome to the video. Today, we are bringing together some of the most respected trading psychologists and professional traders in the world: David Paul, Tom Hougaard, and Brett Steenbarger. Each of them has spent decades studying how real traders think, behave, and perform under pressure. And in this compilation, you will hear their most powerful lessons on emotion, discipline, risk, and behavior, combined into one message. If you truly understand what they're about to share, it can completely transform the way you trade. So if you like this kind of video, please like, subscribe, and turn on notifications. And join the ComLucro community to support the channel and keep improving as a trader. Now, to continue this journey, let's move to the next lesson from David Paul, where he expands on this idea and explains why the mathematics of risk can break a trader long before the market does.
In a 50% system, unfortunately, you get 2 bad ones every 4 trades. Ladies and gentlemen, if you were to bet 50% of your coins on any one trade, you go bankrupt every 4. Gets worse. 8 trades in a 50% system, you have a cluster of 3 bad ones in a row. That means, ladies and gentlemen, that if you were to bet 1/3 of your coins on any one trade, you go bankrupt every 8. And most people go bankrupt because they bet far too much on any one single trade.
What David Paul shows here is a mathematical truth that every trader eventually learns, either through wisdom or through pain. A 50% win rate does not save you. A good strategy does not save you. Even being right more often than you are wrong does not save you. If your risk is too large, probability will always catch up. Clusters of losses are not bad luck. They're part of the game, and only disciplined position sizing keeps you alive long enough for your edge to matter. Now that we've grounded ourselves in the reality of risk, it's time to look at the psychological side of the equation, because surviving the math is only half of the battle. The next trader you're about to hear from believes that most people fail not because of their strategy, but because of how they think. His work focuses on human behavior, emotional instinct, and the mental biases that sabotage even the best setups. Let's move now to Tom Hougaard, as he explains one of the most powerful psychological patterns in trading and why most traders react in the exact opposite way they should.
People are fearful when they're hopeful, and they are hopeful when they should be fearful. What do I mean by that? Imagine you are sat in a position that is making you the aforementioned £1,000. You're no longer hoping that that £1,000 is going to turn into £2,000 or £3,000. No, you're fearful that £1,000 is going to be taken from you. And if you are losing £1,000, you're most likely going to sit there and thinking, wouldn't it be great if this position turned around? You're not fearful that that position is going to get even worse. You're hopeful that it's going to turn around. And if you want to have a fighting chance of making the markets your ATM machine, and this is not a sales pitch, it's a bit of a cliche, I admit that, but if you want to have a fighting chance of making the markets the place where you take money out on a fairly regular basis, you need to turn this around. So let's take a look at not so normal and people who are what we call the 1%. Rather than talking about me, which is something I'm not that good at doing, I prefer to throw the attention some truly great traders. One in particular is someone who I wish I could have met, but he's no longer with us. His name was Charlie D. Here he says, the time you know you've become a good trader is that day you're able to win by holding on to a winning position, and rather than taking half profits, you're adding to your winning position. Rather than beginning to think, where should I get out? You're beginning to think, how can I get deeper in? How can I commit more? He says, there are many people in here, in the pit, that have traded for a long time, who have never added to a winning position. Have any of you ever added to a losing trade? Sure we have. Oh, of course we've added. You know, you bought at 20 and then it goes down to 10. You're thinking, it looked good at 20. It looks even better at 10. But how many of us have bought at 20 and then bought more at 30 and bought more at 40 and bought more at 50? Sure, there will be people who have done it and good on you. But it's very difficult emotionally to add to a winning trade. It's a lot easier to add to a losing trade because, hey, you feel like you're getting a bargain. You feel like you're buying something which is cheap. And hey, when we started learning about trading, what were we told? We were told, buy low and sell high. Quite possibly the most expensive piece of advice ever dished out in the history of mankind. Because every single time I bought low, it always went lower. And every single time I tried to short high, it always seemed to know that I was in and it would go even higher.
What Tom Hougaard explains here cuts straight to the core of trading behavior. Most traders respond to the market in a way that feels natural, but natural behavior is exactly what creates losses. When we're winning, fear steps in and we rush to protect profits. When we're losing, hope takes over and we hold on, wishing for a reversal. This is not a strategy. This is instinct, and instinct is the enemy of consistency. The difference between normal traders and the top 1% is not intelligence. It is the ability to act against their emotions. Now that we understand how automatic emotional reactions lead traders into trouble, Tom takes this idea even deeper in the next clip. And this time, he explains why everything you do when you're profitable feels uncomfortable, and why real trading skill is not about finding entries, but about managing yourself when the market is finally moving in your favor.
No, I prefer to buy high and sell even higher. And I sure do like to sell short low and cover even lower. So Charlie D goes on to say that it's in our human nature to want to cut our winnings. You bought at 6 and you can get out at 7. Get me out! I'll take that profit. That's just human nature. That's who we are. So, he says, if you want to be really good at this, you need to accept that everything you do when you're profitable hurts. It feels uncomfortable. If you're in a position and it doesn't feel uncomfortable, you're probably not betting big enough. I want to repeat that. When you're a good trader, everything you do hurts. And I'm not talking about a smack in the hand kind of hurts or a smack in the bottom kind of hurt. If it doesn't feel uncomfortable, you're probably not pressing the position big enough. Here's a snapshot from an open trade. This is equating to being £100,000 in profit. This is not the result of normal thinking. You see, what I'm doing here is the market is trading at 25,135, but my first entry was at 25,458. But as the market falls, I keep adding to my winning position. What do most people do when they are in a winning position? Now, I know the answer because I sat and watched this for 10 years. When you're in a winning position, what do? Take half profit, nip a little bit more, move the stop loss down so it is almost meaningless to have a stop loss because you're going to be stopped out by the slightest move in the other direction. People are great at taking half profits. They're just not great at taking half losses. We love to take a bit of a profit home because it feels good. It feels like we're doing the right thing. Why on earth would I risk losing some of my open profits? You can't go broke taking a profit. That's what the books are telling me. Now, the amount of time that I have had 10 or 20,000 pound open profit positions, that will then turn into a zero, a countless. My trading philosophy, ladies and gentlemen, is that I will never get out at the maximum profit potential, ever.
What Tom highlights here is the psychological contradiction at the heart of trading. Your instincts push you to add to losing positions because it feels safe, familiar, and comfortable. At the same time, adding to a winning position feels threatening, risky, and emotionally painful. But that discomfort is exactly where professional behavior begins. Successful traders do not act according to comfort. They act according to conviction. They press their advantage when the market confirms their idea and cut exposure when the market proves they're wrong. In trading, the right decisions often feel like the wrong ones, and that is why so few people ever reach the 1%. Now that we've explored how emotions distort decision-making, it's time to deepen the psychological perspective even further. Brett Steenbarger is one of the most respected trading psychologists in the world, and his work focuses on understanding why traders repeat the same mistakes even when they know better. In the next clip, he explains how destructive patterns only appear when we shift into specific emotional states, and why your calm, rational self is not the one executing your trades.
This is a huge, huge idea. It's something I emphasized in my first book, and it's really a cornerstone of the work I do with traders. The trading patterns that get you into trouble, the trading patterns that get me into trouble, are state dependent. In other words, they only show up when you are in a particular state of mind or body. This is why talking to a coach or writing in a journal often does not work, because you are in a nice, calm, focused state of mind when you're talking to your coach or when you're writing in your journal, but under the conditions of actual trading, you're in a completely different state and new patterns emerged. The reality is our behavior is patterned. Just like markets have their patterns, we have our patterns. And our patterns are associated with certain states. It might be a state of anxiety, a state of frustration, a state of boredom. Our patterns emerge only when our bodies and minds get into these states. That's why at the end of the day, how many of you have had this experience? At the end of the day, you look back on it and you look back on your trading and you say, why did I do that? WTF, what? I knew the market wasn't going down. Why did I sell it there? It's because what you know when you are in a calm and focused state can be very different than what you can access when you're in that anxious or frustrated state.
What Brett explains here is one of the most revealing truths in trading psychology. Your worst decisions are not made by the calm, rational version of yourself. They are made by the version of you that is anxious, frustrated, bored, or emotionally charged. This is why so many traders look back at their charts and wonder, why did I do that? It is not a lack of knowledge. It is a change of state. When your emotional state shifts, your behaviors shift with it. And unless you learn to recognize these states in real time, you will keep repeating the same mistakes, even when you know better. Now that Brett has shown how emotions can trigger destructive patterns, he takes this idea a step further. In the next clip, he explains the two psychological extremes that dominate most traders: the impulsive trader who acts too quickly, and the overcontrolled trader who hesitates until opportunity disappears. These two states trap traders in a cycle of fear, frustration, and regret. And understanding this cycle is essential if you want to break free from it.
Most psychological challenges with trading boil down to either being under-controlled on one hand or over-controlled on the other. On one hand, we have the impulsive trader, that's the under control, who loses control out of frustration, out of a fear of missing moves. How many of you have chased a market because you were afraid it was going to move without you? I mean, we've all done that, right? I mean, and you get the absolute worst trade location and the thing just reverses against you. It's very frustrating. That's under control. The fear is controlling you. The fear of missing the move is controlling you. You are not controlling your own performance. The trader who is under controlled, it's almost like they have attention deficit disorder. They lose their focus and they lose their ability to be governed by rules. On the other hand, we have the over-controlled trader. The trader who becomes so fearful and hesitant that they freeze. And so there's opportunity there and they won't take it. I had a situation just recently where a trader had fantastic ideas on the day. And in fact, he emailed a bunch of his colleagues at the firm what he was seeing in the market. Great ideas. They made a bunch of money off the ideas. They came over to him and they said, "Oh, you really nailed that one." Well, what did he do? He never got into those positions. He was emailing. He had all the right ideas. He never got into it. Well, you know, he couldn't get quite the right price, and maybe we'll go down a couple more ticks. He's so anxious about losing money that he never took advantage of the opportunity that he had identified. There's such a need for safety that he couldn't take risk. Attention in that situation becomes self-focused, and so they're not absorbed in markets and not able to act upon what they see. Most trading problems boil down to the issue of being under-controlled on one hand or over-controlled on the other, or sometimes people will oscillate between the two. They'll become hesitant and fearful, then they'll finally make a trade, they'll lose money, then they get angry and frustrated, and then they get impulsive, and then they lose too much money, and then they get hesitant and fearful again, and it will cycle around. So much of trading psychology boils down to techniques for establishing control under conditions of impulsivity on one hand and anxiety and hesitance on the other.
What Brett describes here is the emotional cycle that traps most traders. On one side is impulsivity, where frustration, fear of missing out, or the urge to make back losses pushes you into trades you never planned. On the other side is over-control, where fear of losing prevents you from taking opportunities you clearly recognize. Most traders bounce between these two extremes, hesitating when they should act and acting when they should stop. Breaking this cycle requires awareness, structure, and the ability to regulate your emotional state in real time. Without that, even the best strategies will fail. You have just heard from three of the most respected voices in trading psychology. David Paul reminded us that survival depends on disciplined risk management and understanding the mathematics of loss. Tom Hougaard showed that instinct is often the enemy of performance, and that the 1% succeed by acting against their emotions. And Brett Steenbarger revealed how our internal states shape our behavior and why traders repeat mistakes even when they know exactly what they should be doing. If there is one message that ties all of these lessons together, it is this: trading is not a test of intelligence, it is a test of emotional skill. Your results reflect not just your strategy, but the way you manage fear, frustration, confidence, and uncertainty. Master yourself, and you give your strategy the chance to work. Fail to do so, and no strategy will save you. Before we wrap up, take a moment to reflect on why these psychological lessons truly matter. Tools, strategies, and technical skills only work when your mind is stable enough to apply them. Discipline, patience, and emotional control are not optional. They are the foundation that supports every decision you make in the market. The clearer your understanding of how emotions influence your actions, the easier it becomes to stay patient, follow your plan, and avoid the behaviors that destroy consistency. But understanding psychology is not enough. You also need practical methods to manage your emotional state in real time, especially when the market becomes fast, stressful, or unpredictable. That is why, before we finish, we are going to show you a short clip from our Psychology Mindset Workout for Traders series. In this segment, you will learn a technique called impulse interruption breathing. A simple exercise designed to break emotional spikes and restore clarity in the exact moments when your discipline is most at risk. Let's take a look. The purpose of the drill is to give your mind a quick reset so you can step out of emotional reactions and back into deliberate thinking. During moments of stress, your breathing becomes shallow and your body assumes something is wrong. This exercise breaks that pattern and replaces it with a signal of safety that calms your system within seconds. The first step is awareness. You need to notice the moment the emotional impulse begins. It might feel like a rush in your chest, a tight sensation in your stomach, or the urge to click buy or sell faster than you can think. Many traders try to push this feeling away, but that only makes the impulse stronger. When you acknowledge it and say to yourself, "This is the impulse," your brain already slows down. That moment of recognition creates the space you need to choose your next action. The second step is the interruption. As soon as you feel the emotional surge, you take one slow breath in through your nose. You hold it gently for a brief moment and then release the air with a long, controlled exhale. The long exhale is the key. It signals to your body that the situation is not a threat. Even if your mind still feels pressure, your physiology begins to settle. This shift can happen faster than you expect. That clip is a strong reminder that consistency comes from emotional control, not prediction. The traders who stay calm, interrupt impulsive reactions, and stay aligned with their plan are the ones who turn these psychological principles into real, sustained performance. Please also remember that our mission here on the ComLucro channel is to give traders the clarity and confidence they need to make smarter decisions in the market. Every video, every course, and every piece of content we create has one clear purpose: to deliver practical, easy-to-apply knowledge that helps you grow step by step as a trader. Here on the channel, you'll find complete courses on smart money concepts, technical analysis for day traders, and trading psychology. Because trading isn't just about charts, it's also about mindset, discipline, and risk management. We also share lessons and insights from some of the most respected names in trading, professionals like David Paul, Alexander Elder, Tom Hougaard, Mark Douglas, Al Brooks, Larry Williams, and many others whose experience has shaped the way we understand the markets today. If you enjoyed this video and found it helpful, please give it a like. It really helps more traders discover our content. And don't forget to subscribe and turn on notifications so you never miss our latest insights and strategies. If you'd like to go even deeper and access exclusive content, early video releases, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It's a simple way to support our work and a smart investment in your own growth as a trader. Thanks for watching, and I'll see you in the next video.